How to invest during a recession? Great. It starts with your mindset first. Mindset matters. Habits, rituals. You can't make money until you have the right mindset consistently. So we're going to get into that in this video. It's important to understand that if we learn how to have money flow to us and then be able to deploy that back out, that system of repetition will create wealth and put money back into your pocket where it belongs. Hey, do you want to make money while others are not? Well, check out rule number 1. Don't lose money. Warren Buffett's famous 6 rules for investing starts with this warning: don't lose money. This adage is particularly important going into a recession, especially when the economy faces an inflationary spiral like the one going on right now. As cash loses value due to inflation, wise investment becomes crucial to keep from losing money. How do you keep from losing money? That's the question. How do you keep from losing money? Well, for me, it comes down to, what is your money mindset? Is it abundant? Is it scarce? What are your goals and objectives? What is your relationship with money? Do you get money and are so mad at it that you just want to spend it? Or do you get money and look at it and figure out how they could be Roman foot soldiers for the benefit of your overall wealth to be deployed into different investments and asset classes that is structured, organized, and be able to have you high stepping during a recession? That's the place I want to be. Okay, what are my options? Now check it out. These represent the 4 major asset classes, each with their own strengths and weaknesses. So we always talk about, whenever we look at all of the different investment products that are out there, we want to know, what are the advantages, what are the disadvantages, how does it sit and fit with your core values and tie into your economic philosophy? So the first thing we can talk about is cash, right? Money in a savings account, we know that interest rates are low, right? But we know that if we're disciplined to saving, it's a spiritual game. And that if we use it as a deployment station to put money to work for us in other areas, that's where cash is important. And obviously, you hear it all the time. If you're a single income earner, married couple but single income, you want to have 6 months of fixed expenses. At the same time, if both parents are working, you want to have at least 3 months. So beyond that, you don't want to have like 300, 400, 500 grand just sitting in cash. But you also don't want to go run and buy something either. So there's a mix there, there's an understanding, and that's where it's important that you get with people that could show you how to at least think about that the right way, that's tied to what your philosophy is. The second thing is equities, right? We talk about this often, so I'll keep it simple. The S&P 500. We know from 1980 to 2021, 35 out of 41 years, it ended higher, right? We also know that the average, which is very misleading, folks, but I'm going to give it to you anyway, the average rate of return, including reinvestment and dividends, is about 12.7% during that time. However, intra-year average downside, meaning during the year when it went down, that average is over 14%. Why am I telling you this? Well, because if you're in the middle of a recession, if inflation is rampant and the market goes from 36,000 to 29,000, and you don't know what to do, people make decisions, behavioral investment or behavioral finance, that are suboptimal based on fear and scarcity and mistakes that they can't buy back. So in other words, if you had a $1 million 401k last year, and for whatever reason it's worth 500,000 right now, and then you decide to take all your money out because you're scared, or at least sit in cash inside your 401k, you could be putting yourself in a position that you'll regret later on. The other thing is real assets. So real assets, gold, silver, businesses, rings, watches, the whole 9 yards. There's so many different real paintings. But think of it about a business. So if you're a business owner, how do you turn that asset around? These are questions. How do I make this asset work for my benefit with integrity, with building up my team to get my message out better so we can then bring in more revenues? You have to start asking these kind of questions to yourself like your brain is Google. And what will happen is you'll probably get some people to come into your world that have been there, done that, and know exactly what to do. And these real assets become a major play. Let's say if you're great at your real assets and Joe around the corner just doesn't know how to do what you do, well, that gives you an opportunity with no money out of pocket to go check out Joe, consult with Joe about his business. Maybe you get a piece of the profits, a piece of the company by being able to sit down. I made it sound simple. It's a much deeper conversation. But your business intellect and experience becomes very valuable in that situation. And then last but not least, we have bonds. Bonds, like everything else, are suffering mightily, right? Markets are down. The S&P and the stock market and certain sectors of real estate are down. And all these things are happening right now as rates go higher, which is having an impact on bonds. But somewhere in this dynamics, bonds are important. Once again, I always say, go back to Volcker in the early 80s, check out post Jimmy Carter as that result, and you'll see what happened during the next 7 to 10 years after that. So if we look at these Fab Four, right, and we understand the dynamic of how these works, this is really more than four, because you could kind of branch off into other little things. But at the end of the day, if we can really get connected to this and understand what it looks like to be able to make sure that we're thriving during this economic chaos, which is exactly what I'm trying to share with you, what'll happen is your decisions will be based on logic, math, and science, not emotional timidity. It won't be reactionary. And getting yourself into an abundant mindset creates a lot of financial freedom. Everybody always says, do your research, and I couldn't agree more. It's important to understand how each asset you invest in is likely to perform. Look to past and present trends before investing. For example, in the last inflationary recession during the 1970s, commodities and gold vastly outperformed both the stock market and rising inflation rates. Gold in particular rose over 2,000% in value between 1970 and 1980. This shows the importance of real assets during a recession. Okay, so what does it mean, do your research? Well, you got to understand when you research something, the source of that information. And then you got to dig deeper into what that source is saying, where their source of information came from. And then it becomes a source upon source upon source, all real. But the more research you do with intentionality of understanding and then being able to execute on a design plan, that's the key. Go ahead if you want. Click that link below. We can be that team that helps you do the research. But it's important that as you watch YouTube, as you read this piece of paper, as you read that book, how does that puzzle come together for you so you can make an informed decision going forward? The real secret is time, and I like to call it things I must earn, time, right? So the real secret is time. Your best ally when investing is time. According to Allianz Insurance, 66% of Americans fear a major recession is imminent. And when things are bad, it's easy to believe they will stay poor for a long time. All it takes is a quick glance at a 10 or even a 50-year chart for any asset class to realize that any investment is better than no investment at all. All recessions eventually end. So when we look at charts and we look back in time, right, it's static, it's informational, it's non-emotional. And as you look at these and you eliminate your expectation and just look at the science and time of a chart, and even if it's going to go over 1 year, maybe take that year and break it up over the 12 months and you can see what happened in that year and then kind of put yourself into that place in time. Hey, November, what does it feel like in the summer? What does it feel like in March when my money's tight and the market goes down 30 or 40%? Get yourself ingrained in there and then you'll be able to see no matter what, history shows us that all things do come to an end. So when we look at 66% of Americans feel that a recession is imminent, did they feel that way 3 years ago? The answer is no. Right? So at the end of the day, this still comes down to opinions. And when you look at the charts, the trends, and you see who your friend is, at the end of the day, it comes down to proper planning and mindset. How do you get to a right money mindset? Understand who you are first. Can you game the market? Whew, I don't know about that, but there is a strategy and there's always a way of tilting the odds in your favor, provided you have a long-term, and I don't mean 13 months, but a long-term outlook. Check it out. A common investment dream is to perfectly time the market to maximize returns during a recession. Maybe in the history of the world itself, since the great Big Bang Theory, there may be two people that know that answer, but it certainly isn't going to be me and you. This is practically impossible to do, as no one knows where the bottom is until after going back up again. According to research from Charles Schwab, the best timed investment is only marginally better than the worst after factoring in time for market stabilization and growth. And what he's really saying right there is, at the end of the day, it is so rare for you to be able to time it on either the up or downside, that really being able to kind of have a systematized monthly game or quarterly game plan is really the trick here, even yearly. Listen, I know it's basic and a lot of people know about this already, but let's talk about dollar cost averaging. Instead of putting down a big lump sum on any one investment, stretch your investments out over a long period of time in small, steady increments. This is part of a Forbes recession investment strategy to make sure that you're getting good deals on low barrier to entry assets while they are essentially on sale during a recession. So think of it this way. Every month I got $1,000 I'm going to put into the market, right? And in month one, I'm just making up a number. The investment's at $10. 1,000 goes in at 10. In month two, that same investment's at 5. So now you got 1,000 going in at 5. In month three, it's at 15, right? So now I'm picking up at 15. In month four, it's at 8. In month 5, it's at 11. In month 6, it's at 3. In month 7, it's at 20. When you do that, what's happening is it's still going to give you a steady eddy and a place to leverage off of as time goes on and you continue to dollar cost average. So folks, what you want to do is minimize loss through life insurance. And what I don't mean is that the loss is going to be recovered because you shuffle off this mortal coil. What I actually mean is if you overfund the policy the right way, life insurance becomes like a bond with a seatbelt with no downside. And at the end of the day, it creates a lot of balance when it comes to these overall strategies. You never want to be forced to sell in a down market. If you rely on annuitized income from your stock portfolio rather than selling your equities when they're down, instead you could borrow against a life insurance policy to weather the bear market until the economy recovers. This strategy can save you hundreds of thousands in the long run, but I want you to think about something right now. When you have income that comes off a policy, income that comes off of a qualified plan, think of an IRA, 401k, and income that comes off of an after-tax account, what the insurance does for you, it allows you to manage the tax code. What do you mean? Well, it goes up and down the tax code. So you're in your retirement years, you're 65, let's say the tax code has you at 40%, but then you're 70, it has you at 22%. You then get to decide how you're going to take money out of that insurance and take less when the taxes are higher, take more when the taxes get lower. That's what I mean by managing the tax code. A real good distinction to understand. Anyway, if you're looking to get a game plan with us, go ahead and click that link below. One of the Epic team members will sit down, hear you out, understand your goals and objectives, get down with your economic philosophy, and be able to put a path together and a strategy based on your goals and objectives. We look forward to hearing from you. Okay, folks, this is it. We are in a recession, and the people that understand exactly how to thrive now, 3, 4, 5 years from now, their economic wealth will change. Go ahead and click the link below. Thank you for being such a great subscriber. We're here every day dropping new content. And don't forget to check out this next video.